So let's begin adjustment to final account. The essence of this is for us to appreciate that sometimes after extracting your trial balance, there might be omissions or errors you might have made. So for example, maybe your sales figure was 120,000, but in extracting your trial balance, you made it 100,000. Then it becomes necessary for you to make some of the adjustments or corrections. Sometimes maybe instead of picking the correct figure for a certain expenses, you made a mistake, or you didn't even record an item. So the essence of the adjustment is for us to make all the corrections and necessary entries to make the account reflect the true and fair position of the business. So let's define adjustments, and as I've indicated, these are corrections, corrections or further workings that are effected in the final account of businesses. So they are corrections or further workings that we make in final account. And I think it's clear that corrections or further workings are, as it were, things we have to do to ensure that we provide accurate financial statement for users of accounting. Now, however, in making some of these adjustments, you do make closing entries as well. And when you hear of closing entries, they are journal entries we make at the end of the accounting period to move balances from temporary account to permanent account. The bit of explanation I can give there is, you remember that for the past week, we have been preparing the trading account and profit and loss account. And you realize that the purchases, the sales, return inwards, return outwards, all the expenses and other income, these items are moved into the trading profit and loss account for us to be able to determine our profit or loss. Okay. So imagine the year 2025, all the expenses that we'll be incurring in 2025. Yeah, Prof, I say you have a question.
Mr. Omar, please, good morning.
Morning.
Please, I'd like to ask that this adjustment to the final account of a sole trader and yes, is it going to be done by the accountant or the sole trader himself?
It's going to be done by the accountant. If the sole trader is the one preparing the accounts, then he or she is the one going to do it. But this is the work of the one preparing the accounts. So if the sole trader himself or herself has knowledge in accounting and can do it, why not? If not, he or she may employ an accountant to do that.
Okay, so please, does that mean that, let's say, the business is not a sole proprietorship, let's say maybe it's a partnership or something, are we going to still use this one, or there's another one that will be used, so will be taught or something?
Okay, so the adjustment we'll be making for a sole proprietor, when you get to partnership and companies, some of these adjustments also pop up there. Okay, so it's not only for the sole trader we are looking at this adjustment. They would apply when we get to partnership and companies. just that something new may be added or subtracted. But most of the adjustments are the same for these type of businesses, whether sole proprietor, partnership, or company. So I hope we can move on.
Yes, please.
So now that we appreciate what the adjustments are and what closing entries are, so the closing entries, the point about it is that there are some of the accounts, they are temporal. In other words, at the end of the year, we close them into a temporal account. And an example I gave is the expenses and the income, and then purchases and sales. Okay, those accounts are transferred into the profit and loss account, okay, to determine the profit and loss. So the next year, those accounts would not have any opening balances. We just open fresh sales and purchases account to continue for that year. Okay. Now let's look at some of the adjustments we have to look at here. So like I indicated to you, there are about 10 of them that we have to look at, 10 adjustments. Okay. So we'll look at each of them, explain it, and also show how you make the adjustment in the final account or financial statement. Okay. So let's quickly run through the 10 adjustments. So I think one of you can read what you see on your screens for me.
Adjustments to final accounts of a sole trader. Adjustments are corrections made on account of further workings that are effected in final accounts. The following adjustments are made to accounts. 1. Accrued expenses. 2. Prepaid expenses. 3. Income owings. And 4. Income prepaid.
Okay. From 5. Continue from 5.
5. Goods withdrawn for owner's private use. 6. Cash withdrawn for owner's private use. 7. The proprietor's private expenses charged against the firm's expenses. 8. Provision for depreciation. 9. Bad debt and provision for bad and doubtful debt. 10. Interest on loan.
Okay. So thank you very much, Prof. So the 10 adjustments begins from accrued expenses, prepaid expenses, income owings, income prepaid, goods withdrawn for owner's private use, cash withdrawn for owner's private use, the proprietor's private expenses charged against the firm's expenses, provision for depreciation, bad debt and provision for bad debt, and finally interest on loan. So these 10 adjustments is making us appreciate that for a sole proprietor, these are some of the major adjustments that are effected in the final account. There are several adjustments, but these are the 10 we'll be looking at for the purposes of our discussion. So one, we need to know what each of them is, as in what they mean, and then how they are effected in the final account. So please, professors, pay rapt attention. If you have any question at any point, draw my attention to it. The first one, accrued expenses. Prof. Dameki, if you can read for us, accrued expenses. Dameki, are you there? Okay, Frank, if you can do the reading for us, I think Dameki might have an issue.
Accrued expenses. This refers to an amount of expense that have been incurred but not yet paid for. It is also called expenses due or outstanding or unpaid or owing. Accounting treatment in the final account. In profit and loss account, expenses due is added to the expenses paid, and the result is debited. In balance sheet, it is shown as a current liability.
Okay, thank you very much for that. Now, it's important we understand what is on the screen or what we have read. So, the first point is that we need to understand what accrued expenses are. And it says that these are expenses that we have incurred, but we have not paid for it. I think this is very understandable. You have incurred the expense, but you haven't paid for it. So, example, you go and take somebody's building, you rent it for 1 year. Okay, as in you stay in the building for 1 year, but you haven't paid the rent. In such a scenario, we say that you are owing, and for that matter, the rent has accrued, or the rent is due, or the rent is outstanding, or the rent is in arrears, or the rent has not been paid. Okay, so expense accrued simply means expense that you have not paid. You have incurred the expense, but you haven't paid for it. I believe professors understand this point. Okay, now how do you treat it in the final account? So pay attention. The first treatment goes into the profit and loss account. Okay, so you remember in the profit and loss account, you bring your gross profit, you add other income, and you less expenses. So as you are lessening your expenses, if for example it is rent accrued, then we are saying you add it. You are going to add it. And then in the balance sheet, you will show it as a current liability. It's a liability because you haven't paid. It's something you are owing. Liabilities are debt or owings. Okay. So let me see if I can show you or demonstrate how this is done in the format. Okay, so let's look at this question and find out. Okay, so this was the question. Now, most of these adjustments appear in the
previous slide again.
Yes, I'll get back to that. Hold on. So if you look at the question here, most of the adjustments are given in the additional information. Okay. You appreciate that what we have done so far didn't have any additional information. In fact, the only additional information that was given was the closing stock, but we didn't have any additional information to, as it were, adjust. So when you see additional information, and for example, look at this one, you see telephone outstanding, then you see accrued salaries. We have just understood that outstanding, accrued, they are all the same thing. They mean you haven't paid for it. Okay. So if we are preparing our profit and loss account, the point is for telephone, as an example, we are being told that there is an outstanding of 660. So what we do is we go to the trial balance, check how much telephone expense we paid, and you see that here in the trial balance, which is 3,000. So this 3,000, we are going to add the 660 outstanding. Okay, So let me show that to you in the solution. So in your profit and loss account, you see, under your expenses, of course, the telephone is an expense, right? So you see the 3,000, we add the 660 outstanding, okay? And whatever we get becomes the total expense for telephone. Now, when you go to the balance sheet, as it was indicated, that 660 outstanding will be part of your current liabilities. So you see telephone outstanding under our current liabilities. So that's the point being made, that if you see any expense accrued or outstanding, add it in your profit and loss account, and in the balance sheet, show it as a current liability. Please, do we appreciate the point? Please, any question on what I've just explained? Okay. So, professors, you need to know this accrued expense and know how it is treated. Okay. I think we can move on to the next adjustment. The next adjustment is prepaid expense. Prepaid expense. And if you analyze, you can tell that this is the opposite of accrued expense. But let's read and see what it is also about. Prof. Dameki, if you are now available, please can you read it for us?
Prepaid expenses refers to an amount of expense paid in excess of what has been incurred. It is also called expenses paid in advance. Accounting treatment in the final account, profit and loss account. Expenses prepaid is deducted from the expenses paid and the result debited to profit and loss account. Balance sheet, shown as a current asset.
Okay, thank you very much. Will any of my professors, compare this with accrued expense and explain to us what we've just read? It's an amount of expense paid in excess of what has been incurred. And to treat it, you'd have to deduct or less in the profit and loss account and in the balance sheet. Okay, Professor.
So please understand the prepaid, how different the prepaid expenses is from the accrued expenses. Is that the question?
Yes, asking if you can explain the prepaid expense to us
So
with
the
an
prepaid expense.
with an example, if you can.
Okay. The prepaid expenses, it says that it refers to an amount of expense paid in excess of what has been incurred. So let's say, for example, a company is going to, let's say you deal in cars or something, and then you buy this Range Rover and then it's 20,000, but then you gave your dealer 25,000. So I feel like how I understand it is that the 5,000 is the prepaid
Okay.
expense, is the excess of what is to be paid.
Okay. Okay. Thank you very much for that point. Any other professor to add on? Frank, you want to add your voice, or maybe Dameki, you want to say something to top up what Professor said? Okay, so I think that's the point. Expense prepaid here means that you have paid for the expense, but actually you haven't incurred the expense. So example, I think the most common one is the current electricity prepaid system, where you pay for the electricity before you even come and use it. You go to the vendors, you buy 100 cedis, then you come to your home before you slot it in your meter for you to start using it. So you make the payment in advance before using the electricity. I think when you were in the primary schools and the JHS, those of you who were paying school fees, at times you pay your school fees in advance. That means you prepay your school fees. So you are in Form 1, but it's possible that you pay your fees for Form 2. Yeah, some of us or some students were doing that. They pay the fees in advance. So we say that if this happens in your profit and loss account, you would less it. Now, the rationale is that, for example, if the rent for the year is 3,000 and you have paid 3,500, in your profit and loss account, you have to tell us that my rent expense, yes, I've paid 3,500, but the 500 is prepayment. Okay, so you less the 500 from the 3,500 to arrive at 3,000, which is the true rent for that year. So that's the rationale behind deducting or lessen the prepayment, because in essence, it does not form part of that particular period. So we have to less it. And in the
Come again.
okay, so is it with the example I gave?
No, the one that you were like, you have to make it and the 3,500. Yes.
Okay, so my point was that if your rent for a year is 3,000 Ghana cedis, but you paid the landlord 3,500. Okay. Then, if you are preparing your profit and loss account for the year, the amount of rent you have to charge as expense should be 3,000, because that is the rent for that year. In other words, if I ask you, what is your rent for the year? If you tell me 3,500, that would be wrong, because your rent is not 3,500. Your rent is 3,000, but you have paid for 3,500. Okay, and you know in accounting you have to report on everything. So in your profit and loss account, you are going to state, okay, that my rent, okay, is 3,000, all right, but this is what happened. I paid 3,500, but 500 is a prepayment. So you less that prepayment 500. And when you less it, you arrive at the true figure 3,000 as the rent expense for that year. So that's the rationale behind lessen prepayment. And as I indicated to you, the opposite is accrued, and you realize for accrual you add. So for prepayment, you less. Now in the balance sheet, this prepayment is seen as a current asset. So under your current assets, you would indicate expense prepaid. So you see example here, rate prepaid. Okay, it is your own money because you haven't used the money. In the case of rent, if you pay your rent in advance, you can go to the landlord and claim it if you haven't stayed in that room for that period. You can go and say, please, let me have my advance. I don't intend staying in the building for that period. So you can claim your money. So it's your asset, it's your resource, but a current asset. Okay, so that's also the bit about the prepaid expense. Prepaid expense. Professors, are we good? Any question? Okay. Let's quickly run through the next two, which is accrued income and prepaid income. So we've seen for expenses, we are now looking for income. They seem to have something in common. Accrued income, okay, refers to, well, I think our new professors, one of them should read for us. Prof. Alexia, please read accrued income for us.
Also called income due or outstanding. Final account. Income due is added to the income bracket added to gross balance sheet.
Okay. Okay, so accrued income, okay, refers to the amount that we have earned, okay, keyword there, earned, but not yet received. Now, please, in order for you not to be confused, we pay expenses and then we receive income. As a business, we make payments for expenses and we receive income. So accrued income means that the income we are supposed to receive has not been received. In other words, we have earned it, but we have not received it. Okay. However, since it's also accrued or owings or outstanding, in the profit and loss account, you add it. But note that the income is added to the gross profit, right? So as you add other income to the gross profit, if there is any income accrued, you would add it as well, okay, to how much you have received. And in the balance sheet, it is seen as a current asset. Let me use an example to make you understand. Let's take, for instance, that we are dealing in vehicles, right? And then we rendered some services for, let's say, a school. They were looking for vehicles to take their students to school. They couldn't buy the car, so they said, oh, if we can arrange and take their student, then they'll pay us commission. So you see that to our business, we are going to receive the commission from the school and it will be part of our income. Now, if we take the students to the school, it means we have rendered the service and we have earned the income, as in the commission. However, it's possible that the school might not pay us instantly. They can say, oh, please, we'll pay you next year. If that happens, then we'll say the commission has accrued or is due. That income is due. So if we are preparing our profit and loss account, yes, we will state it in our account that we have earned that commission, just that it has not been paid. So we'll add it to our income. And in the balance sheet, since that money is our own money we have earned because we have rendered the service, we show it in the balance sheet as our current asset. And I hope that settles any confusion. The opposite, which is income prepaid. Okay, let me quickly run through that. Income prepaid or prepaid income. This one means that, like the example I gave, the school has asked us to take their student to school and they'll pay us commission. This time, we haven't taken the student to the school, but the school has already paid the commission. So as a business, we have received the commission, but we haven't performed or rendered the service of taking the student to school. So at that point, we have received the commission, we have received the income in advance. How do we treat it? We say that in the profit and loss account, we have to less it. We are lessing it from our income because technically we haven't earned that income. So we don't have the right to add it to our income. So you less it. And in the balance sheet, it is a current liability. It is a liability because you have not earned the thing. If the school decides, okay, please don't take the student to school again, give us our money, then we'll have no basis to argue. We'll give them the money. Okay. So let's pick few questions if there are. We have 3 minutes to end the session. If there are questions, please, professors, break it on board. Let's discuss. So Prof. Ashley, Prof. Alexia, Aseye, Damaki, Frank, and yes, Aseye, you have a question. Please go ahead.
Please, I'd like to ask that why is it that okay, so I'd like to ask that with the prepaid income, right? It's just that you've not yet rendered the services, but then you've been paid.
Yes.
It's not that like the payment is in excess. Like let's say they're supposed to pay 3,000, they pay you 3,000, even though you've not rendered the services, not 3,500.
So both cases can occur. Let me give you an example. If we are to take the student to the school for, let's say, 2 years, okay, 2 years, so 2023 and 2024, or let me say 2024 and 2025, okay. Now, the school has paid for both 2024 and 2025. So what have they done? They have paid in excess, and for that matter, our business have received in excess of what we have actually earned. Okay, because 2025 has not even ended. We are just in January, but we have been paid full 2025 commission. So we have received in excess of what we have earned. Okay. So either you haven't rendered the service and you have been paid, or you have rendered the service to some extent, but you have been paid for the full duration of rendering the service. So both cases apply.
Okay. Thank you.
Please, any other questions? If there are no questions, let's join the second session and continue with the other adjustments. So see you all in the next session. Thank you.